What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, I want to share 6 reasons why I believe that dividend-paying whole life insurance is the ultimate sales vehicle. This thing is just incredibly powerful, guys. And I wanted to make this video because I think it's really important to understand all the different things that we can do with these policies and all the different benefits that we get, and to shift the conversation from what mainstream media says and these mainstream influencers like Dave Ramsey or whatnot who completely lie about how whole life insurance works, and shift the conversation from whole life insurance being just a very expensive way to pass on a death benefit to beneficiaries, when in reality, when you design these in a specific way, they are incredible places, incredible vehicles to use to save money, store large amounts of capital if you're building up emergency and opportunity funds, just like I am. It's one of the reasons I set up my policy. Because as my marketing business started doing good, I was saving a lot of money. And, I was doing T-bills and high yield CDs and things like that. And I still do that because interest rates are pretty high at the moment. But, at the end of the day, we're always looking for the best place to put our money, right? The most efficient places to put our money, maximize growth, get as much benefit as we can. And I just don't think people really understand how dividend-paying whole life insurance can be that vehicle that provides us a really, really solid financial foundation and just a great place to store capital. So I want to go through 6 reasons just to get you thinking about these policies a little bit differently, because they are incredibly powerful. They've been absolutely a game changer in my own life. I'm working on my 2nd policy right now. So if you guys want to learn more about how you can design these policies for max cash value, get that 3 to 5% net tax-free compound growth every single year, which is actually reason number 1. We'll get to that in a second. But I'll have some additional training in the description that breaks down my specific policies, the ones that I've set up, so you can get an idea of what these things are capable of. It's really cool. So let's get into it. Reason number 1 that I love dividend-paying whole life insurance as a savings vehicle is you get the typically these policies will net 3 to 5% tax-free compound growth every single year for the life of the policy. It is really powerful. And when you think about a savings vehicle, that to me sounds really good. Now, a lot of people like to compare that to the stock market. Oh, well, I can buy term and invest the difference and get far greater returns than 3 to 5%. Fine, do that. I don't care. Buy term and invest the difference is not for me. I'm going down the path of infinite banking, dividend-paying whole life insurance, alternative investing, and all that stuff. I share my journey on exactly how I'm using my policy for building wealth in the description. You can check that out. But guys, when we think about if you're going to open up a savings account at your bank and they were going to give you 3 to 5%, let's just call it 4%. Okay, we'll stick in the middle there. If they were going to give you 4% compound growth, uninterrupted compound growth, tax-free, would you say, oh, you know what, I'm not interested, I'd rather put all my money in the stock market? No, I mean, that's a really good savings account, right? The difference is, though, the savings account doesn't give us all the other benefits of whole life, which is a lot of the things that we're going to cover in this video. But at the end of the day, 3 to 5%, 4%, call it whatever you want, that might not sound like a lot. But guys, when you understand how compound interest actually works, those numbers, depending on how you fund your policy and how much you're able to put into it, that can grow into significant numbers, a significant amount of money over the long run. And what are people already doing with their money, like, through their 401ks and IRAs and things like that? Well, you're storing money for the future. Like, it's a long-term investment strategy, right? Where you're planning 30, 40, 50 years down the road. You're planning for retirement and trying to create that retirement income. Well, this is no different. We're setting up a savings vehicle, 3 to 5%. That's it's going to get uninterrupted compound growth, and you would be amazed at how much that what you fund the policy with, what that can grow into over 30, 40, 50 years, as long as it's uninterrupted. Which dividend-paying whole life insurance, it's one of the only vehicles, one of the few vehicles, I should say, that gives us that true uninterrupted tax-free compound growth. I'm not aware of any other vehicle. Feel free to share it down in the comments if you know what that is. I'd love to find out. All right, reason number 2 that I think dividend-paying whole life insurance, ultimate savings vehicle. safety. All right. So when we think about saving money, storing large amounts of capital, building up an emergency fund or an opportunity fund, we want that money to be safe, right? So that's why we typically put them, put that money in savings accounts or just things that are generally known to be safe, low volatility, no risk, right? So when you think about putting money in a 401k, to me, that's not saving money. That's investing money for the future. Not saying not to do that. 401k is fine, whatever. I'm not a fan, but not saying anything bad about it in this video, okay? But to me, that's more saving or investing because you're riding the volatility of the market and you're hoping that the market's going to perform in a specific way over the long run, right? With savings, when it comes to our safe money, all right, we don't want that volatility. Like when we go to access that money when we need it, we want to know that it's going to be there. The amount that we saved is going to be there, plus any interest that we earn. We don't want that volatility. We want instant access to it, which we're going to get to in a second. We can do that with whole life insurance, but we want that safety. Now, when it comes to safety, the research that I've done, there really isn't a much safer place to put money, large amounts of money and capital than mutually owned life insurance companies, which is who we purchase these dividend paying whole life insurance contracts from. Okay. They are the absolute best when it comes to risk management. And all you have to do is look at history, guys. You look at some of the greatest financial crises that we've experienced. You go back to the Great Depression. How many banks failed during the Great Depression? I think it was, what was it, 8,000, 9,000 banks went under. It lost the last, when I was doing my research, it was a little while ago. I think it was like $180 billion. That was back in the 1930s. $180 billion. Imagine what that would equate to in today's dollars of depositors' money just gone. And banks are supposed to be these safe places to put money. And yet their track record, their resume for being safe, not so good. You go to the savings and loan crisis. How many thousands of banks failed then? How many banks went under during the great financial crisis? Just like, you go throughout history and banks kind of have a shaky history when it comes to safety. And you look at the same period of time, how many mutually owned life insurance companies went under? I mean, the ones we work with, they paid dividends throughout the Great Depression, the savings and loan crisis, the great financial crisis, World War I, World War II. They paid dividends out to their policyholders. They've never missed a dividend payment throughout all of that chaos. So you tell me which one is safer to store money. I'm going with the mutually owned life insurance companies when it comes to safety. Like they get a big thumbs up in my book. So the history of these companies, like they're just known for being really good at risk management. They're also not subject to fractional reserve banking. That's with bank runs and currency drains and all this risk that a bank can run into. That's not the purpose of this video, but when you start to put the pieces of the puzzle together here, for me, when I started going down that rabbit hole, learning more about banks, mutually owned life insurance companies, doing a comparison, etc., I started to feel a lot more comfortable having large, like my safe money with the mutually owned life insurance company. Now I still have bank accounts, you got monthly expenses to pay and whatnot, but I don't keep a large amount of money in the bank anymore. I just don't. Like when I come into a windfall of cash, I'm looking at setting up another policy. I'm setting up my second policy right now because I know that money is going to grow at 3 to 5% tax-free compound growth every single year. Plus, it's safe. Like in my opinion, they're a lot safer than storing the money in banks. All right. So that's reason number 2. Reason number 3, liquidity. All right. So we have access to our cash value inside of these whole life insurance policies. Now, if you listen to people like Dave Ramsey and like just people that don't know what they're talking about when it comes to dividend paying whole life insurance, they'll tell you, it takes 2-3 years to even get access to it. In traditional whole life policies, that's true. But when you set these up for cash value, because you can custom design these policies, guys, it's the difference between base premium and paid up additions. I'm not going to go into detail in that about that in this video. You can check out my Infinite Banking University in the description for more details on that if you want to learn more about it, or you can YouTube it. But you can direct where the money goes inside of the policy. So, for example, I set my policy up for a lot of cash value. I had access to a large portion, about 86% of the money I put in first year. I had access to that in the 86% of it in the first year. So I could get access to that money in the form of a policy loan, and then use that money to go build wealth like I'm doing right now. I do a lot of alternative investing, private money lending. I flip heavy equipment. I'm doing lots of different things with my policy. So I get access to that. I mean, I go into my portal, I tell them how much I need, and it's in my account in 2 or 3 days. So it's excellent for emergencies, opportunity funds. It's a great way to continue building wealth like you normally would. But the advantage of it is you're not actually taking your money out of the account like you would a savings account. For example, if I'm going to lend on a real estate deal and I've got my money in a checking account or savings account, I'd have to take that money out of the account, which is no longer earning interest. Okay. And I'll go make money, with the deal. That's great. And I put the money back in the account. But what if I can make money twice here, where instead I borrow against my cash value, that cash value doesn't actually leave my policy. So it's going to continue to get 3 to 5% tax-free compound growth every single year while I lend on the real estate over here. And if I can borrow at 5.5%, make 12%, plus my policy is continuing to grow, why on earth would I not do that over and over and over and over again, right? Because in the pushback I get on that is, well, you're paying interest to borrow your own money. You're not. You're paying interest to borrow the life insurance company's money. But if you think about this from a business perspective, which is essentially what we're doing with these policies, we're kind of starting our own banking enterprise here, and because we're utilizing the policy as kind of like our own bank, right? There's always a cost of doing business. For example, in my marketing business, I pay $500 a month for one piece of software to run part of my business. Now, on the surface, if I just stop there, that might sound crazy, right? Like, why would you pay $500 for one piece of software? It's because of all the benefits that I get from that software. If I pay $500 a month to make $10,000 a month, why on earth would I not do that over and over and over again? Why? It's just a cost of doing business. So when we pay simple interest for our policy loan to get that liquidity to our cash value, that's a small price to pay to continue to get the uninterrupted compound growth tax-free while we continue to build wealth over here. It is an incredibly powerful system, guys. And I did a full training on the difference between simple and compound interest and why you could actually pay upwards of 8% on the policy loan, only earn 4% in the policy, and your policy will still come out ahead in the 5-year example that I gave. It's incredible. Check it out in the description. All right. So reason number 3, we get access to our cash value, liquidity, and it doesn't interrupt the compound growth that we're getting in that policy, guys. So reason number 4, the tax advantages. I've kind of alluded to this, mentioned this a couple of times already, but there are some great tax advantages with these whole life insurance policies. The tax treatment for these is the cash value growth is technically tax deferred because you can create a taxable event with these policies. If you mech the policy, if it becomes a modified endowment contract, the IRS then treats it like a regular tax qualified investment plan or whatever. All right. But there's ways to avoid that. When you structure and design your policy properly, you can avoid that MEC status. So you'll get the tax deferred growth, but then you can also access all of growth, all of your cash value tax free later on in retirement if you want to. Usually that's done through policy loans. You want to work with an experienced agent on this. You don't want to over leverage the policy, cause it to potentially lapse. You want to be careful with that. And it shouldn't ever be your only source of retirement income either, but it can be a great source of supplemental tax-free retirement income because you're taking policy loans against it. And it's a loan, it's debt. It's not income. It's not treated as income. So there's some just incredible tax advantages that we get over the long run as well. So absolutely love that. All right. Reason number 5, the living and death benefits. All right. So if we think about a traditional savings account, all right, you got money saved up in the account. All right. If something were to, let's say you passed away, unfortunately, tomorrow, unexpectedly. All right. And let's say you didn't have the policy, you just had the savings account. All right. That savings account, I mean, maybe if you had a will, might be able to avoid probate, whatnot. A lot of people don't have it set up that way. Unfortunately, so it'd probably get locked in probate. There's lots of fees, taxes you're going to have to pay as well. Not to mention once your beneficiaries receive that money, then that's going to count towards their income as well. And also, they would only get what's left over after that entire process, right? It would not blossom into a massive death benefit like a whole life policy would. Right. So, we can have $100,000 in cash value, for example, but maybe we have $1 million, $2 million death benefit over here. So if something were to happen to us, instead of our family just getting the 100,000, they'd get this massive death benefit, income tax free. So it's a phenomenal way. In addition to all the benefits that I've already talked about, it's also protecting our loved ones financially in case something were to happen to us. If we were to pass away unexpectedly, we know that our family is taken care of. The living benefits, if you get diagnosed with a chronic or terminal illness, all right, would your savings account blossom into a pretty decent amount of money, tax-free, so that you could choose the treatment that you get? Maybe you want to do some alternative treatment, whatever disease it is that you have. A lot of the times, health insurance, long-term care insurance, things like that. There's a lot of restrictions, a lot of red tape. I've seen this before. Not saying that they're bad and not to have it. But my point is, with a whole life insurance policy, they have these living benefits where you can get access to a large portion of your death benefit early if you are diagnosed with a chronic or terminal illness. It is a really, really amazing benefit. It's one of those peace of mind benefits. Those that external rate of return. A lot of times we're always chasing like internal rate of return. What's the best rate of return I can get on a policy, in the stock market, real estate deal, whatever. We don't think about the external benefits that we get, a lot of which I've talked about so far. But that peace of mind, knowing that if something were to happen, you're solid financially. You would have options. You would have choice. You'd have dignity. You would be in control. To me, you just can't put a price on that. All right, final reason, number 6. Upside potential and downside protection. I wanted to throw this in here because I don't think a lot of people know that you can get upside potential in the market with downside protection in a whole life product, indexed whole life insurance. It's a rider that gets basically just an attachment to your whole life policy. You don't have to use it, but I do a lot of comparisons, a lot of videos like with IUL and whatnot. I personally think IUL is pointless because of this. But do your research. Maybe an IUL makes sense for you. But once you understand how it works and that you have the option of getting upside potential in the stock market without the downside risk, that is a pretty good benefit. So if you're on the fence or you're thinking about IUL, or maybe you're just really hung up on the fact that, I could get better returns in the stock market, well, you could potentially use or at least want to consider using the indexed option rider on these policies to where you can get that upside potential without the volatility of the market and still get the guaranteed growth rate inside the whole life policy, because every whole life policy comes with that guaranteed growth rate. It's usually between 2 and 3/4%, and then plus any dividends you would get every year, which they've never missed a dividend payment, the ones that we work with. So anyways, just another really cool benefit that we get, and just another reason why I think these are just the ultimate savings vehicles. If we're thinking long term and we're trying to store capital, we're trying to build up emergency funds, opportunity funds, guys, you really can't get any better than a properly structured, properly funded, dividend-paying whole life insurance policy. So if you want to learn more, please check out the links I have in the description. I have a ton of training on this, and just educate yourself, guys. Just focus on educating yourself, building up your knowledge, understanding how these things work. That way you can make the decision on whether or not this makes sense for you, because it doesn't make sense for everybody. But once I learned how these things work, how these policies work, all these benefits that we get, it became an absolute no-brainer for me. And in fact, I'm trying to set up as many policies as I can. As my income grows, I'm setting up new policies. Like I said, I'm working on my second one right now. So anyways, I hope this was helpful, guys. I hope this brought a little bit of clarity to the conversation. If you guys want to have a conversation with myself or my team to discuss your goals, your situation, see if just to help you decide and figure out whether or not this makes sense, we can run some illustrations for you as well, show you what the policy could look like. I'll have a link down below as well where you can book a call, free coaching call. All right. So anyways, I hope you guys are crushing it. I hope you're doing well, and I will talk to you in the next one. To your success, Matty Ice is out.